Guys, welcome to today's video. And today we're going to talk about the good old trading alert rooms. Ever since I posted my last video, quite a few of you guys have messaged me asking me, hey, well, what's a good one? What's a bad one? What to look for? What not to look for? So I said, you know what? Let me go ahead and give you guys kind of a little breakdown, the do's and don'ts, what to look for, what not to look for. So let's get started. A few things we're gonna go over. Number one, what is an alert room? Second, who offers the service? Is it worth it? Pros and cons. And lastly, what exactly to look for when thinking about paying for the service. All right, so that's going to be the things that we're going to be talking about today. So, well, first and foremost, what is an alert room? Well, an alert room is simply put a service in which a person or a group of people go ahead and offer, in which ideally they um, they call out trades, right? May that be stocks, options, Forex, so on and so forth. All right. And in return, they charge you a fee. That fee may be a fee, most often will be a fixed fee, either monthly, quarterly, every 6 months, yearly, or even lifetime. Some alert rooms, what they'll do is every single month they would only open up a an amount of positions, just say 100 people at a time, and every single year, every single month, they reopen that alert room. Another one is where they, instead of charging you a fixed fee, they charge you a percentage of the profits. Now, with that one, personally, I wouldn't consider that an alert room. That's more of an account management, which is a little bit different. And the big differences is that in an account management, you have to have enough trust in the individual or the group of people. You give them your money, and in return, they trade for you. So again, today we're just going to simply talk about alert rooms. Specifically, we're going to talk about Forex. Like I said, there are different ones. Some alert rooms they'll just simply call out stocks, either stock options, futures, commodities, all of them, or they might offer just some of them. Okay. So, but again, today we're going to strictly focus on Forex. So the very first thing that you want to look for when it comes out to Forex is you want to make sure that whoever calls out the trades are calling out trades when you're awake. Why do I say that? Well, in the Forex market, Forex opens is open 24 hours a day, 5 days a week. So, for example, if you live in the United States, just say in Chicago where I live, if you you live in Chicago and the alert room calls out trades during the London session, well, during that time it's like 1, 2, 3 in the morning. Chances are you might not be awake, or maybe you are. Again, it all depends. You just got to make sure that this is the trades that they call out are at the time that you are awake. Very, very important. I know it might sound obvious, but I have seen people where they put in whatever it is the fee, $50, $100, $200, but then they realize, oh crap, this person only calls out trades during the London session, and again, they're sleeping or they just can't catch the trades. So again, make sure that you are awake during those times that they trade. Very, very important. Second thing you want us to look for is what kind of trades do they call out? Do they call out scalps? Do they call out day trades? Or do they call out swing trades? And for every single one of them, there are certain things that you also want to look for, which I will go in details on every single one. So again, you want to make sure what kind of trade they are because some people prefer scalps, in and out trades. Some people prefer that day trade, or some people may not have enough time to keep an eye on their trades, that they just want that swing trade. So that's another thing. You want to make sure what kind of trades do they make, do they take, or what kind of trades do they call out. Let's say that you want to do scalp trades. What to look for with scalp trades? Very first thing you want to look for, and this is honestly for any type of trades, you want to make sure what is their not only their win rate, but also you want to make sure what is their risk to reward. Here's the thing, guys. A lot of these alert rooms are going to talk about how they have such a high win rate, 80%, 90% win rates. Well, here's the thing, guys. If somebody is claiming such a high win rate, two things are happening. Number one, they're just strictly lying about it, or number two, the risk to reward is probably not the greatest. I'll give you guys an example. So I'm not gonna call out names. I'm not gonna call out any specific groups. I'm just gonna say my experience with them. There is one alert room in which they claim a 99% win rate. That's insane. 99% win rate. But here's the thing. The risk to reward is disgusting. What they do is they call out the trade. Most often they're day trades, swing trades. They have four different take profits. Each take profit is 20 to 30 points, but in between each other. But their stop loss is 100 pips. So what does that mean? If you're going for TP1, you're basically risking, let's say, if you have 100,000, $1,000 account, or just say a $10,000 account, and you're risking that 1%. That means you're risking $100 to make $20. Personally, that's not the type of win rate or the type of risk to reward that I want to get into. Okay, so that's the one thing you want to say. Usually, if they claim a high win rate, either they're lying about it, or chances are they have horrible, horrible risk to reward. Okay, so with this one, like I said, they claim a 99% win rate. What happens is that if a trade goes against them, right, they're just gonna keep that trade open for weeks or even months. And I've actually seen that. I've seen it got to a point where I think one trade was called out like 8 months ago, and then out of nowhere, I saw the notification saying, "Oh, TP1 hit." Just imagine holding a position for 8 months just to say that you didn't lose the trade. So again, that's not my style of trading because if you do the math, let's say even if you have $100,000 account, and if you find yourself needing to hold a position for 8, 10 months, you're not going to make a lot of money if you're following proper risk to reward. So again, that's something you want to look for. What is their risk to reward? Win rate, it is important, but it's not the make or break. If the person or the group has 60% win rate, but if their risk to reward is a 1 to 3, then you're going to be profitable. Personally, I'd rather have a risk to reward of 1 to 2, 1 to 3 with a 55% win rate than have a 95% win rate claiming but having a risk to reward of risking 100 to make 20. That's my opinion, right? So again, look at what the risk to reward is. Another thing you want to look for scalping. As you guys know, scalpers they tend to look for that quick in and out trades of 5, 10, 15, maybe even 20 pips. You want to make sure that you're actually able to get into the trades because, again, from experience, the ones that call out scalp trades, most often they call it during the most volatile time. For example, in the New York session, they call it out right at market open. At 8:30 Central Standard Time, they call out a trade. Well, what's the point of being in an alert room if 90% of the times you can't get into the trade? Or if you do get into the trade, you're not gonna get in. You're not gonna get in at the price that the signal provider called out. So at that point, either you're risking, um, you're either risking, losing a little bit more money, or again, unless you do a set percentage, you're risking more compared to that person. But also, that kind of skews their the win rate. Because again, I've seen certain alert rooms where they do scalp trades, and they're like, oh, we're in a 10 trade win rate. But in reality, chances are a lot of those people either couldn't even get into the trade or probably they lost themselves because they're counting again. They usually have multiple take profits, and maybe a few of those times TP1 hit, and that was the only one that hit. That one to that 1-to-1 risk to reward TP hit. So the stats that they're giving out may not be a true reflection of the members. Because again, you want to make sure. Personally, what I recommend is if they're calling out scalp trades, two things that I would rather see. Number one, instead of doing market orders, that they call out limit orders, sell limit orders, buy limit orders. That way you know that whatever price they're calling in, chances are you're gonna get in that price. Okay. Now at that point, it's gonna be up to you at what take profit you want to go over, right? And we'll talk about that as well later on. So right now we're just gonna go over the things to look for first. So again, personally, I would want to look at buy limit orders, sell limit order trades, or if they're gonna call out market orders, I rather would want to see that this signal provider that they call out strictly one thing. Either they just stick with one pair, one NDC, one commodity, whatever it may be. That way you know when they say, hey, get ready. You know there's gonna be that one pair or that one NDC. Again, from experience, I have seen some alert rooms what they'll do if they do market orders, they will say like, hey, scanning the markets, be ready. So again, you want them to once at least they give you a warning to say, hey, be ready. Again, that doesn't guarantee you're gonna enter at the same price, but at least you have a chance to get into that trade. Okay, so that's the very thing that I would want to make sure you guys focus on. Now, when if the alert room offers multiple take profits, the thing that I will recommend for you guys to do is pick which one you want to follow. Here's the thing about this. A lot of these alert rooms, again, if they show you their record, for example, they're gonna be showing you the best case scenario record. So like again, if it's TP four different take profits, they're gonna show you as if you got out on the right take profit. This is what the with the percentage gains it would have been. But again, that's not the case. And I will say this, I am I've done this myself where when I show the record, I'm showing you best case scenario as if you knew exactly when to close out that position. And with this, if you're trying to go for TP4, you will want to make sure how many times or how often does TP4 hit. Does it hit 30% of the time, 40% of the time, whatever the case may be? Make sure you go through those. If it hits TP1, If you're looking for TP1 only, check, well, how often does TP1 hit? Same thing with TP2, TP3. Okay. Or if you're able to, simply go for TP4 and then just trail your stop loss. That's very, very important to do. Personally, what I do when I call out a trade, like I said, I also call out different take profits, to call out different, well, yeah, different take profits. But I'll show you guys. Well, if you would account for TP1 this week or this month, this is what the winning percentage would have been. Or this is what, how many, if you're risking 1%, this how much you would have gained this week for TP1, TP2, TP3. I only call out three take profits. For swing trades, usually I don't call out profits. I usually just trail the stop loss. But again, that's we're going to talk about what to look for when it comes down to swing trades and kind of like the expectations. So yes, so scalp trades, summary is make sure how are they calling it out? Are they calling it out as limit orders? Are they calling it out as market orders? If they call it out as market orders, preferably make sure that they give you a warning prior to entering a trade and that they stick with one or two things at a time. That is what I would recommend for you guys to look at. Now, day trades. Day trades are usually trades where the trader will hold the trade for a couple hours or a few days, or not a few days, or a few hours on that same day, and they'll close out that same day. For those, typically a trader or provide like a real trader will wait until the market settles to call out a trade. With this one, ideally they'll only give you maybe one or two take profits, and that's it. Me personally, like I said, I usually call out. I call out a little bit of everything, kind of like help out most people. Um, like right now, recently, the last couple of weeks, I've only really been calling out swing trades. So, day trades again. The ones that I've seen typically go for 1-to-1, 1-to-2 risk to reward. On this one, you want to make sure again what is their win rate. If they're going for a 1-to-1 risk to reward, you want to make sure that they have in the long term at least a 51% win rate. Okay, with a 1-to-1. With a 1-to-2, they can get away with a lower win rate. So again, with day trades, make sure same thing with the scalps, but just make sure the win to reward, the risk to reward, and the win rate. You don't really have to worry too much on the entry. Because usually with their entries and their take profits tend to be a little bit wider. Like I said with scalps, scalp trades, they probably go for 5 pips, 10 pips, 15 pips, or like if you're doing Nasdaq, or US 30, it might go for 10 points, 15 points, 20 points, whatever the case may be. But with day trade, like I said, they'll probably go for, if you're doing US 30, they might try to go for 100 points, 150, maybe even 200 points for the day. But again, you also want, like I said, you want to make sure that they have proper um, risk reward. Give you guys an example. There was one that I was following, and for a long time they were actually giving out, proper risk reward. They were giving out four different take profits, but between TP1 and the stop loss, it was 1-to-1. TP2 I think was like 1-to-2, 1-to-3, and then TP4 would be 1-to 4. So it was US 30. They were 50 points for TP1, 100 points TP2, so on and so forth. And then they changed it. They changed it to only three take profits of 50, 100, and 150, which again, perfectly fine. Um, since at least the risk to reward is a 1-to-1. But just recently, I've noticed this is something that I don't like. Again, it's up to you on this one, but I've noticed that they changed their stop loss size. They've increased their stop loss to 80 points, and then they made TP1 kept it at 50, TP2 put it at 100, and TP3 at 200. Me personally, I'm not a fan of that because it's not at least a 1-to-1. It's a I don't know, I can't do the math, but it's not a 1-to-1. It's less than a 1-to-1 risk to reward. So in this case, you would want to make sure that this individual has a little bit of a higher win rate, and you would have to go for at least that 1-to-2 or that TP2. Another thing that I'm not a big fan of this one that he's recently done is sometimes he would even expand his stop loss. So instead of making it 100, 80 points, I mean, they might bring it up to 120 or even 150. Again, personally, not a fan of that. I don't want to risk more than because like, I base my risk based on a percentage. So if he, for example, if he says that the risk, the stop loss is 80 points, I base those 80 points on a 1% risk. But if he's giving me, 160 points or 120 points, then that means that now I'm increasing my risk by 1.5% simply so he can say if roll the dice and if it hits TP1, well, hey, we got the win, right? Again, personally, I'm not a fan of that. But if you're willing to take that risk, then go right ahead and do so. Last one that we want to talk about is swing trades. With swing trades, this one is more so for the person that may not have a lot of time to get in and like look at the markets and look at the graphs or anything like that. It's just simply open up a trade and you hold it for many days or many weeks. The pros and cons behind it is, well, pro is again, you don't have to keep an eye on the charts or on your MT4, your broker, whatever it's going to be. You don't have to keep an eye on it every single time. The con is don't expect a lot of trades. Sometimes you may only have 5 trades throughout the month. Um, Another thing is don't expect crazy win rate, or I mean, don't expect crazy winning percentage, nor don't expect a high risk to reward. Typically, swing traders, we look for at least a 50 to 55% win rate, and the risk to reward could be a 1-to-1, 1-to-5, maybe a 1-to-2. Really, it depends. Unless they feel very bullish, then they'll probably go for a 1-to-4 or 1-to-5, whatever it's going to be. Um, or they do what I do is they just trail their stop losses. So once they hit a certain point system, or once they hit just say a 1-to-1 or whatever the case may be, they'll keep trailing that stop loss because they want to get as much of the move as possible. But again, like I said, don't expect a high win rate. Don't expect a 10, 20, 30% gains per month. This type of trading is best for people with higher balances. Okay. So, to wrap things up, what to look for when it comes down to the alert rooms. If it's scalps, make sure that they stick with a certain instrument or investment tool. May that be a certain pair, certain indices, certain commodity. Ideally, make sure that they have limit order that they do out, right? Like buy limit orders, sell limit orders, that's the way they call out. Or at least that they give you a warning before getting into the trade. The cons behind it is most likely you're not going to get into a lot of the trades, or you're not going to get into the price when it comes down to those market orders. With the buy limit orders, sell limit orders, the cons would be you might not get a lot of them. Like I said, I've been in some where through the course of the week, you know, there's only 5 trades that was called out, but only out of the 5, maybe just 1 or 2 of them actually triggered, right? So that's the con. The pro is chances are you are gonna get into the right price, the price that alert room called out. Then at that point you want to make sure you pick which take profit to go. Whichever if they allow multiple take profits, you want to make sure you pick the right one. Intraday trades, what to look for. You want to make sure they have the proper risk to reward. You want to make sure they have the proper win rate. Over 55% of win rate, at least a 1 to 5 risk to reward. The pros is chances are you'll be able to enter at a decent price or at the price they call out, because typically they try to get a little bit of a bigger move, and you don't have to keep looking at your phone. Just preset your take profit, preset your stop losses, and then just go about your day. The cons behind it is the emotional side. Sometimes the trade might go against you for a while, so you might not be ready mentally to see those stop losses or see that negative. And yeah, it's pretty much only the con. The win rate again, it varies, but it's usually over 50% of the time. The last one is the swing trades. The pros is again, chances are you're gonna get into the trade. You're going to not have to worry about looking at the charts all the time, right? And but you're not don't expect such a high win rate, and don't expect for a huge percentage of gains throughout the month. Okay. One thing that I forgot to mention when it comes out to swing trades, you want to make sure that they're not calling out swing trades with a high stop loss. Now this might be like a more of a personal thing that I'm not a fan of. Um, I don't like when a trade is called out and they have like a 200 pip stop loss with a 200 pip take profit. Personally, I feel that if I need to have such a high pips in stop loss, then I'm too early for the trade. I wouldn't get in that trade. Personally, when I call out swing trades, they're either, when it's like a pair, Forex pair, it might be only 60 to maybe 100 pips. If it's, NASDAQ, or if it's like, for example, recently SPX, my stop loss was only 30 points. Instead, it was a swing trade. Another pair that I called out, which is, I forget which one it was, but let me see. Hold on, give me 1 second. I recently called out a Euro Aussie pair, and my initial stop loss was only of 60 points or 60 pips. Currently, we're over almost 300, and, we've been holding for like 3 days. But anyways, personally, I wouldn't want to get into a trade that has such a high, stop loss count in pips. So keep that in mind as well. That's something that I forgot. The reason why I said it, because there is one alert room that I'm actually still in, that some of their trades, that's the way they call out, where they have this crazy, crazy 200 pip stop loss, and sometimes it will take, you know, a whole month to hit take profit or to hit stop loss. Personally, I don't like to keep losing trades for too long. I like to keep winning trades for as long as possible, but losing trades, either I'm wrong right away or I'm right away. My style of trading is like again, if I'm on drawdown for a week or 3, 4, 5 days, I'm just gonna cut it loose. There's no point of me having such a huge stop loss. Anyways, that's like I said, that's the things you want to look for. If you guys have any questions, feel free to comment down below. Maybe there's some stuff that I miss that I'm glad to respond or answer to. So yeah, If there are any other ideas that you want me to talk about, any other type of videos that you want to make, please let me know. Make sure you hit the like button, comment, and subscribe to the video. I will be making more educational videos like this. Like I said, my goal is to make sure that people are exposed. Like I've said before, especially in the Forex industry, there's so many scammers out there. My goal is just keep it real for you guys, give you guys the education so you guys can make the proper educated guess and to see if it makes sense for you or not. So once again, thank you very much, and I will see you guys in the next video.